I realized I might have a career in something that is non-tech, so finance and so on. And I truly learned therefore what venture capital is, what is early stage. I saw it for myself, right? And I decided, look, it's better for me to work at a startup because I'll do tech, I'll do product management, and I'll see how early stage really works.
Hello, everyone, and welcome to a brand new episode of the Indianaut podcast, where we interview some of India's next best analytical and creative minds who are not only revolutionizing their own field, but at the same time, transforming India's entrepreneurial ecosystem one step at a time. Our guest for the day is a testament to the power of strategic investing, entrepreneurship, and fostering innovation. As the founding partner and chief investment officer at 314 Capital, our guest has left an indelible mark on the world of venture capital and startups such as CheQ, Jupiter, Licious, Open, and Darwinbox. With a passion for nurturing innovation, he has led over 70 seed and venture capital investments, injecting life into ingenious ideas that are shaping industries across India. Our guest's journey has earned him accolades, including the 35 Under 35 award from Entrepreneur magazine. We have with us Pranav Pai from 314 Capital. Let us jump right into the conversation. Hey Pranav, I hope you're all settled in.
Nice to be here, Gautam, and thank you for the invite.
Awesome. Let's get started. So I hope you like the set of questions I have for you today. Let me kick things off, right? So my first question is about the origin story of 314 Capital. So Pranav, founding 314 Capital must have been a pivotal moment in your journey, right? Can you talk about the genesis of 314 Capital's origin and share your journey of venturing into venture capital? So was there any specific moment or experience in your life that actually sparked your interest in this field?
Yeah, definitely. And I think it's an unusual journey into VC for most people this young. Everyone has had some spark somewhere that's changed their mind about following an atypical path. And that's kind of what happened to Siddharth and me together along the same time. So really quick, I'm an engineer by training. While I was at Stanford for my master's in electrical engineering, 2011 to 2013, it was an extraordinary time. I remember Facebook going IPO, Steve Jobs passing away. Peter Thiel was on campus taking that course that became that book, 0 to 1. Snapchat was on campus recruiting. I think they were a 120, 130 million valued company. A bunch of us in EE, unfortunately, said no to that job, went on to become an $80 billion juggernaut. So a lot of interesting activity on campus back then for those of us who had come for our masters from India. And I think it really opened our eyes. It really opened our eyes to how much of that promise of tech, right? That tech will be everywhere one day and everyone will be using tech and there's a smart device in everyone's pocket and so on. That time we were still talking about the mobile internet and smartphone penetration across the world, right? And of course, the US was leading that charge with Apple and Android and so on. So we got to see from the the center of gravity of tech, basically, what the future could look like. And a lot of us on campus back then, we had obviously with masters, especially engineering, the typical role is to apply for a job, Google, Facebook, Microsoft, that's what you aspire to. But startups had become this mainstream activity on campus, right? Now there were courses teaching you about startups. There were legendary investors like Thiel coming and talking about why, you should not even go to college. In fact, you should just start a company right out of school, high school. So I think it challenged a lot of those very fundamental notions we had about our plans for our careers. And I think I really credit those 2 years for opening my mind up to, yes, there is a lot more control I can take, a lot more agency I have in the decisions I make. And I should actually work backwards from a specific goal and see where that takes me instead of, taking it one step at a time and iterating. And, you can work both ways. But I said, let me try the other way. Let me try working backwards. So I set 3 very important aspiration points, like break points down the line. I said 2013 is okay, I'm done. I've studied a whole bunch of things. I'm pretty good at what I do. Of course, I'm top of my class in wherever I come from in India, but at Stanford, everyone is top of the class. So that means, normalize in weird ways. It's a big reality check for where you are truly globally. But once you're through all of that, it's like a prayashchit for those of us who know what that means. And it opens your eyes up to also being honest with yourself. What are you good at? And therefore, what should you not have delusions about in terms of your competencies? So I said at 2013, there are 3 things I know I want to do and where I want to be. So I said very clearly, I want to come back to India. That's not negotiable. However good it looks, wherever I may end up after 2013, I have to get back to India within a certain time. And that was an important personal commitment of mine. I'm very happy I made it. And that meant, of course, I had to say no to a PhD. I had to say no to certain types of jobs. I had to say no to certain visa processes. I had to say no to, buying a house or whatever, right? Just go to rent and don't build a permanent position. So there are a lot of things that once you are set about where you want to be, like a little bit far out, I think a lot of decisions answer themselves. And I like that. I like taking some of that decision burden off. I like having a break point telling me, therefore, these things should work this way. Second, I saw a lot, unfortunately, about how broken the narrative is about India itself, right? And back then, this is pre-2014, pre a lot of the progress we've made as a country. India was politically not in a very stable place, unfortunately. And I got to see truly for myself, once you're out of the country, what's right, what's wrong, what's totally untrue, by the way, about some narratives about India. If you lived here, you know things work differently compared to what the headlines in the BBC or whatever are normally trying to pose as truth. So I got to see also the dislocation between reality and a narrative about reality. And I think that was really important to me. And therefore, I said I must arm myself with as much of this as possible so that I can judge reality truly, right? And I can make sure I'm not living in a delusion myself. So I said that made sure I took myself out of my engineering process all the time. I forced myself to learn other areas, from finance to political science to international relations. I took as many of those courses as I could. I just had broke into lectures whenever I could. I didn't sleep much. I mean, that goes without saying. But I think that was important. It was important for me to know. I had to force myself to know those things. And finally, I think the most interesting thing I decided was I realized I might have a career in something that is non-tech, so finance and so on. And I truly learned, therefore, what venture capital is, what is early stage. I saw it for myself, right? And I decided, look, it's better for me to work at a startup because I'll do tech, I'll do product management, and I'll see how early stage really works. And that will give me more options for what I do next once I go back to India, right? I could work in a startup, I could work for a VC firm, I could work in a large company that has intrapreneurs and so on. I could work in an accelerator. So giving myself a startup experience would open up more branches of possibility for me. So I think that was why I worked in a SaaS startup after 2013. I spent close to 4 years in a SaaS company. We got acquired in 2020 for just under $400 million. So my ESOPs were worth something. I saw what that means also. It means so much. You have a few basis points of a company, but when that finally realizes something and cash comes into your account, it means so much, right? You really feel like you earned something. So I've been through all of that. And it gave me a really profound admiration for how valuable venture truly can be in changing lives, in bettering society, and truly solving problems if it's done the right way. So that's my experience. And coming to 314 now, after 2013, after I graduated, I came back to India quite often. And I tried to meet as many VCs as I could. So I was working in a startup. I was employee number 3. I could use that as an excuse to meet VCs just to get feedback on what I'm doing. How do you see the market changing and so on? 3 things struck me as very unusual in India versus the US from the VC perspective, right? So I was a startup operator trying to meet VCs. That was my avatar back then. In the US, if you're a Stanford kid, you're working in a startup, you're assumed to be reasonably smart, of course, and you are.
Right.
It's very unusual for people to not give you time, even 10 minutes, right? They say, "Come on, I'm walking to get a coffee. Why don't we walk together?" Right? The default is let's talk, let's meet. When I came to India and I asked, like 30 VCs, 20 of them were in Bangalore for time, maybe 2 replied. Right. And I know they saw my email because, I know how rate receipts and all work with standard performance marketing tracking. So I thought it was really unusual. Look, I'm not some, general uncle, kid from the street. I'm reasonably relevant to you as a VC, right? But I saw the first problem founders were talking about in India back then. That is really hard to get time with these guys. And I thought it was really unusual because this is deal flow. Like this is your fundamental job to meet as many companies as you can. So you pick the best stock to invest in. So that was one problem identified. I think there was something unusual about Indian VC back then. Second, when I actually got a meeting, I saw in the US, they were trying to learn from you, right? Because most of them were operators. Most of them had built companies before. They were hyper curious, right? And it became almost like they're trying to extract something from you. So sometimes it goes too far and you have to learn where the boundaries are. But it was a great experience to meet them. And, you feel like you've been heard, right? That's a really good feeling to live in a human being when you meet them. It was the total opposite here. And again, I think it was a cultural problem because there were so few VCs and so many founders trying very interesting things that these VCs, quite naturally, I don't blame them, had somehow figured out that, we are gatekeepers, right? So they have to come to us and, therefore I can use my time in specific ways. It became a leverage point. And I thought that was something that, had to change. Founders had to have more options. This condescension had to go away. And the third interesting thing was, back then there were just a few $100 million being invested every year. As I studied reality, like I said, just open yourself up to what's happening. You were hearing about UPI, you were hearing about these things that were changing. You saw the elections change and you saw a big focus on what was back then called Digital India. And you could see, okay, there's a big tide coming that if you time correctly, hopefully, a lot of things will be very different. And therefore, if you enter that market in a certain point in time, you could do things differently. So I'll conclude by saying a lot of these experiences helped me realize I should actually jump a few places, not join a startup, not start a startup, not join a VC firm. There's actually room to start a brand new type of VC firm that does a lot of things differently, right?
Right.
Now, of course, it's worked. In hindsight, I can say that was a good decision. In hindsight, I think the biggest blunder I made was not opening my eyes fully to how difficult it was, why it was so challenging, why were there so few VCs, why was it so hard to raise capital, why did India only have a few $100 million invested, why were there only one or two unicorns back then, right? So those are things I didn't have answers to until I actually joined and saw the industry from the inside. So interesting experience. I would say I'm very satisfied to say I never want to go through that again, but I'm glad I went through it because it made me pretty good at what I do. It really opened my eyes to doing it a little bit differently.
First of all, Pranav, I think it's incredible having that incredible clarity at such a young age. Let's talk about how your journey shaped 314 now. Okay. So you and your brother, you started 314 Capital, right? What I want to understand is that during this experience, while you were working at that SaaS startup as employee number 3, as well as your conversations with VCs, what do you see is 314 Capital's investment thesis now, and how much of that has been shaped by your prior experiences? So, what I want to understand is that what factors do you now look at when you consider whether or not to invest in a startup? You can talk about the macro perspective, you can talk about the micro perspective, but I'd love to understand that are there certain criteria or unique approaches the firm follows when evaluating potential investments?
Absolutely. I think there are 3 columns of dimensions, right? There's the people dimension, there's a market dimension, and then there's a product and solution dimension, right? At the startup that we were at, we were lucky that we had a founder CEO who was hyper networked. This was his 3rd company, right? And he exited both of the previous 2 companies, made money for his investors, I think $400 million and $600 million. So back then, those were very large exits, right? And of course, he had himself experienced what it means to have equity value be realized for himself, for his team, for his leaders, early employees, et cetera, et cetera. So if you are fortunate enough to be able to work with a founder like that, right, as an investor, as an employee, both sides, I think you're able to see how many things come naturally to a person like that. Okay, so the people dimension, the most important thing I would say is when we evaluate the founders who come to us as this unit that is going to start a company, most of the time it's 2 founders and a laptop and they come to us. This is really early. We ask ourselves, okay, there's no track record, there's no P&L, there's no revenue, there's no, sometimes not even a product. There's some wireframes on Figma today. Back then they were drawing some sticks in a PowerPoint. So I think you have to really be able to vision a future together, right? And it's really risky, by the way. When we were in that company and we were going to Sequoia and we went to a whole bunch of things on Sandal Road to pitch, I must give credit to the VCs that we pitched to, that they really had to rely on our vision of why are we seeing a problem, what is it, who we are, why we're equipped to solve it, why we know we can build it this way, why we know these big companies will use our software, we give it to them. So I think the people dimension, your ability to network, your ability to come with a competent track record, your ability to hustle together a team that as a unit is able to convince people to take that risk with you. I think the people dimension is very important. And we also realize along the way, the reason VCs everywhere in the world spend so much time on people is because one of the biggest risks in a startup when you invest, one of the biggest reasons startups don't turn out to create value is because the founders fight. The founders don't get along, or the team doesn't get along. Founder disunity is one of the top 5 contributors to it not working out, right? So at 314, we evaluate the people dimension very closely. So we look for things like, how are these 2 guys getting along? Are these 3 founders getting along? What is their complementarity? And maybe the most important thing we ask is, do they know this market better than we do? Now at 314, we get 7,000 to 8,000 companies pitching to us every year, right? Over close to 8 years now, we've seen tens of thousands of businesses. So let's assume we know some of these markets really well, because thousands of founders have come and spoken to us about the same business model, right? So even if we are not that high IQ, assume for a moment, just by the volume of information coming to us makes us pretty good at knowing these markets. Right. So these founders and this team have some insight about that market that we don't have, right? So the truth about that market that makes them really special and gives them an inspiration, that's the people dimension. Then there's a market itself. Now, even if the smartest people come to you as a VC and pitch to you a company that's going to solve something that no one cares about, however hard you try, however beautiful the product is, you will never make great returns, what is called a VC outcome, in a market that doesn't support it. So we're very specific about markets. In fact, if you ask me, what is the number one thing you do in your time outside of managing a portfolio and the team and everything, I'm studying markets, right? In fact, I go after LPs, people who invest in our funds, specifically because I want to learn something about the business that they are in by having them invest in our fund and then using that as an excuse to get closer to the insights they have about that market. So in 314, because we are such fanatics about certain markets, and that has helped us preempt other VCs and hopefully create category creators, the market you're in is a big draw to us as investors. And finally, I think it's obvious. If you're great people and you're in the right market, but your product is wrong, your pricing's wrong, we want to get a lot of those things understood between us and the founding team very early on. Something we like to take risks with, right? So it's okay for a company to tell us, look, we don't know how to monetize yet, but you're going to build these things that people will come back and the retention is going to be off the charts, right? That's also fine. Sometimes we've invested without a clear revenue story on day one. The revenue story comes maybe after year one when you see behavior. We're willing to take that risk. But if we don't know what we're getting into and we don't agree on, okay, here are the risks we're taking non-monetization for a year type risk. If you don't agree on that, then there's no way we can build a company together. So the product, how it's going to look like, the shape of the company going forward, that's the third column. So 3 columns, a lot of time is spent. But given that now that we've done this, like I said, tens of thousands of times, and we've invested in over 100 companies, now we can make decisions in days, right? Sometimes hours, because we know the team, we know this, we know that. So I think now it gets really refined. And I must credit a lot of this to not just me, but Siddharth, Anurag, Nitya, all of our experience as operators.
Definitely.
Before we became VC.
And I think, Pranav, it's also incredible and noteworthy, right? That because all of the partners at 314 Capital have had some sort of an operator background, right? You've firsthand experienced how, taking that bet on a startup and actually working with it and making it reach heights, actually sees wealth creation also happen firsthand, right? Because like you said, you actually saw your minor equity stake actually converted to cash in your account, right? And I think having that experience also creates a sort of an empathy, also creates a sort of a right judgment when it comes to the people aspect specifically, that you now know that, what it takes for the right team to work together to go through all of the struggles and work towards success. So I think that's incredible, and I think that really talks about 314's investment thesis. Another aspect that I loved about your answer is that, so the way I see it, if I would have asked you the same question back in 2018, 2019, 2020, 2021, or even today, right, your answer, I feel, would have largely been the same. It's not something that you're going with the flavor of the month and adding that input and all. I think your answer is exactly the way it's evergreen. It stands the test of time, and I think that's what matters. Yeah, definitely.
Absolutely. And then I think, look, that's Gautam, that's the only way to anchor yourself in reality, right? Reality, honestly, does not change as often as people think. Right. Truths don't change as often as people think. And I think in any investment environment, public markets change every second, right? I mean, it's unusual how you have to be able to be a great investor there. So therefore, taking yourself away from the second by second ticking and just reminding yourself, where are the truths? I think that is the only way to anchor yourself in helping you create great value over a decade. There's no other way to do it.
Awesome. That's incredible. So, Pranav, let's talk about the macro environment landscape for a minute, right? So the global and Indian macroeconomic landscape is currently facing a lot of challenges, right? So how has this personally affected 314 Capital and the VC space in general in terms of deal making, valuations, and exit strategies? So can you share some thought that you have, that 314 Capital has, to navigate these volatile times?
Absolutely. Look, there are some, again, truths about our industry that if we didn't embrace fully, the number of times now markets whipsaw would have, hopefully not, but definitely have turned us senile by now. So when we launched the first fund, we spent 5 years building up a clear understanding of this business, the venture business, startups, because that's another part of the component of the business, and then the markets, the capital markets, right? So we are a tri-party type business model. And it was undeniable for us that since our funds are 10-year funds, 9-year funds, 11-year funds, whatever, right? Every VC has their own tenure. It's inevitable that we'll face a couple of great years, like say 2021 or whatever, 2018 was a decent year. And we're going to definitely face the really bad years, right? The bond markets will change, some war will happen. And sometimes all of it happens at once. And that is a really bad year. So it's inevitable for us to embrace that all of this is coming, right? So for us, we had to design a very carefully constructed approach to a market over 10 years that prepares us to be performant during good times and bad. Okay. So what are the answers therefore? So what does that look like? Say we raise 100 rupees, right? we have to first have a very clear idea of the model of how 100 rupees becomes, say, 400 rupees. So 4x fund. That is a minimum in our view that we have to deliver to our investors, right? And that's a 21, 22% IRR, whatever. So that I think knowing that this is the end state, right, gives us clarity. Therefore, okay, we have 100 rupees. How many companies? What is the failure rate typically in the industry? What is our failure rate given our track record, which is many percentage, actually many X's less in 314. And how will we exit, right? We have had close to 20 exits. We know how to exit also and where that will happen and in what year of a company's life and so on. So we know for all probabilities of outcomes inside the 100 rupees, what types of companies, what kind of endpoints they will reach. And therefore, we have to pick a number of companies, right? So sometimes it's 20, sometimes it's 25, sometimes it's 30. For different VCs, they have different models. Assume it's, say, I'll give you a simple round number, 25 in 314. We also have to be very honest that we're not some super genius, lucky forever type, dice throwers. We're not throwing dice. Every one of these companies are real people, real jobs, real money, real risk. We can't act like people throwing darts, which is a lot of the angel funds, a lot of the blogs that are out there. They really make this look like a game of chance, right? It's not. You cannot take games of chance with people's lives. That's really important. And we treat each one of those 25 investments in that 100 rupees as we have to make these companies successful. That's very important. So the intention, right, the sankalpa of the investment on both sides has to be, guys, this is our life now, and we have to make this work. Now, if all of this stacks up, right, you will still lose some companies along 10 years. Some markets will still have very large competitors enter, or they're already there and they suddenly become very good at being competitors, and those companies may not survive. So you have to be very clear that you're going to lose some companies even if you did things right? And finally, you don't have control over things like founders fighting and so on. You can't predict those things. So after all of that, you have a model that assumes certain attrition and so on. What we've realized is when there is a good year, you can see it coming now. Okay, we can see bond rates change. We can see flows work because we're capital market participants. We get signals from all the networks that we have and all the reports that we read to know that a bad year is coming, a good year is coming, some inversions are happening, all of that people write blogs and tweet about. So it's very clear now the signs of what's coming. Sometimes it may not. Those signs may lead to some event happening much later. So you have to be careful that not everything is causative, but you can prepare for bad times a little bit more aggressively if you know what to read. And therefore, when a good time comes, we have a very simple solution. We work with our companies very closely to make sure there's cash on the balance sheet, right? So for example, in 2021, I think we closed like 70, 72 follow-on rounds across all of our companies. Today, in 2022, 2023, these have been relatively bad years. Our companies have survived, thrived, turned profitable because there was cash on the balance sheet, right? Because we helped them raise equity. Right. And we work with these companies to inform them very clearly, guys, this is unusual. It's a good time. We have to use what we have to raise capital and make our balance sheet strong. And therefore, on the bad times also, we have to now convince founders because sometimes there's a hangover, right? I just raised all this money. Now you're telling me the market doesn't exist. It's bad times. I just raised 3 rounds in a year. What do you mean bad times, right? It takes time for even the best founders to admit, yeah, times have changed and it's actually a bad year. So they have to change how they use capital, how much they use for marketing, how fast they turn profitable. And we have to be reliable people to tell them, guys, it's a bad year now. There's another year of badness, a worse time coming. We have to change the model early enough to change the ship. And depending on the size of sometimes these are unicorn companies with 100, 200 million in revenue, writing that ship a different way takes 2-3 quarters, right? It can't happen immediately. So we also have to work with our founders to adjust them to bad times and prepare them for what's to come. So I think it's a lot of work. I don't think you can do this without being involved in the companies. But definitely, like you said, being an operator, having done this now dozens of times, having done this over 100 companies, your authority, right, on what you're saying is true and what you're saying is a strategy that you have to take seriously. I think that also gets a little bit heavier, a little bit more useful over time. So all of that is how we make sure over 10 years, we still make a 4 or 5x. We've done better than 4, of course, but the minimum 4x we've achieved over all the funds we've raised so far.
Awesome. That's incredible, Pranav. Pranav, I'd like to double down on this, right? So you spoke about portfolio company support, right? So I'd love for you to share some specific instances with us where 314 team's involvement actually made a significant impact on a startup's growth, And how does the 314 team collaborate with portfolio companies to provide support and guidance beyond financial investment?
So at 314, we're very clear that from the inception, when we launched the firm, Siddharth and I are both partners. We're both equal partners. We have the same title. We have the same compensation, the same carry share. I'm an investing partner. He's a non-investing partner. We're both equal. And that's very important because at inception, when the firm is set that way, then all the teams that we build, I built the investment team, I helped build the growth team. Anurag joined us as an investing team member. He's now a partner. So when we elevate people, they are also an investing partner. Nitya is on the growth team. She's a non-investing partner. So as people grow inside the firm and they get elevated to partnership, there's also a balance that is continued in the operating nature of the firm. So in our view, we're very clear. We have both sides is equal. The investing team, of course, does their job, and it's just, we have a stock that we've invested in, and once it's part of our, we call them stocks because it's a portfolio and so on. Once we have a stock, the non-investing part, the post-investment teams, we have many teams there: finance, compliance, growth, platform, so on and so forth. All of them are working with the company to make it successful, right? And that's the only way for us that we can help these companies over 10 years as a relationship reach the value that all of us have an aspiration for from an end result. And that, I think, has changed how founders work with 314 as well. In every other firm that's invested, VC firm that's invested in a company, you're only always talking to the investing partner, right? He's on your board, she's on your cap table, she comes up and gives reference calls to other investors, so on and so forth. But in 314, you have a variety of people who speak for the company, who work with the company, and who show up as an avatar to help that company in different situations. And that means there's more variance, there's more ideation, there's different points of view, there's more opinion testing, and therefore the decisions we make are also a little bit more rigorous. And the founders see that there's more work done. It's not just some gut instinct. I saw this 20 years back, therefore I'm this very senior fellow, listen to me. There's no condescension either, right? Everyone is truth seeking to make a decision.
Right.
So I think that mode of operation is what has helped us. So all these teams, it's all on our website. It's all these teams, post-investment, it's all these teams continuously working with these companies. And even after our companies are IPO'd, right? We've had our first IPO last year. We have many companies planning their IPO soon. Even after IPO, if we're holding the stock, we still want this operating team to continue. So we also trained our companies to think like public market investors, what the market's saying. It's very different, of course, very different. But we also have to know how to deal with those situations in the positive upside. Of course, negative upside when companies don't work and so on. It's the same bunch of people helping the company to a graceful landing. So all of these things, I think, is essential for asset management. It's the only way we've given the outperformance that we have. Honestly, we don't know how to do this any other way, right? So it's all come from bottom-up thinking. No one told us to do it like this. If we followed what every other VC did, we look very different. But we look different today because it really is what the need of the market requires us to be.
Absolutely. And I think one takeaway that I have from your answer is that your non-investing team doesn't look at, say, a specific stage of a company, right? It's not looking at early stage, it's not looking at growth. It's 0 to 1, 1 to 50, 50 to 100, 100 to 1000, whatever the stages, your team is equipped to manage that. And I think that's incredible. That's truly amazing. And I don't think a lot of venture capital firms in India have that kind of knowledge or have that kind of insights into how they can support a team which is, say, 2 members, a new startup, as well as a team that has gone, IPO'd. So I think that's incredible. So Pranav, I want to double down on this. Can you share a specific instance with me where, which can highlight where 314 has been, instrumental or has really supported a startup incredibly?
Yeah. Let's talk about, one of our best known companies. So Licious today is one of the most valuable D2C startups in India. It's a category creator. There was no model like that before Licious did it.
Right.
When it first launched, Abhay and Vivek were the co-founders. Abhay is a phenomenal guy, knows the market really well, really passionate about great food, great experience for his customers. And Vivek comes from VC, right? He was very senior at Helion. Helion was one of the biggest VC firms in India.
Right.
They split up 4 VC firms that come out of them. Great people, very smart team. He knows all the VCs, right? Because he's been at Helion, not just Helion, but the entire ecosystem. Now, in spite of that, I told you about networking and who you are as a founder and so on, and what you're known for. In spite of that, no one invested in Licious, right? And we were not a very known brand. 314 Capital today, we show up on some newsletters and so on. But in 2015, 2016, we were just incorporated. We were waiting for our license when we met these guys from SEBI, and literally they had reached the point where they had to talk to like fresh funds like us just to get that seed capital. And honestly, they were raising 2 to 3 crores, right? It's not even that much in today's comparison. And their valuation was between 10 and 20 crores. It was nothing, right? But these were phenomenal guys. We knew this market really well, right? And we had a ready thesis that yes, there's a big play in farm to fork food. And of course, we identified animal protein, we identified 2 other areas. But when these guys came to us with that very similar thinking that we're going to build a brand, and we're going to work backwards all the way to build a supply chain, and it's the first time this is going to be done in India, we said that's exactly what we want to fund. we'll do it, right? So we led the seed round. Honestly, it was a very small round. So they didn't have enough cash to even prove out the full scale of the business. But I must credit them with that capital, with that frugal mindset. We worked with them just to focus on one neighborhood in Bangalore, just one neighborhood, not even the full city, just one neighborhood in Bangalore, and show repeat rates, show that retention, show that customers are coming back, show that they're willing to pay a premium for a better product compared to just walking down to the butcher shop and getting that black packet with the smell, right? So they were disproving a lot of the things that VC said will never happen in India. So it was very important that the seed capital we gave them, we didn't tell them, go build a unicorn with 2.5 crores. That's a nonsense submission to them, right? It's a nonsense expectation. What we said is, guys, just this neighborhood, show that a lot of the VCs who said no to you for the seed round, show them that there's something about reality that they have not seen yet. That's it, right? That's the evidence we said. That's the burden of proof. I must say they did remarkably well. They got a seed. They got a Series A round within 9-10 months of the seed round, which back then was very difficult. Normally took 15 to 18 months to get the next round. So I must credit them by saying, we will show the market. We will show them they're wrong. We will show them we'll do it. And us also agreeing with a narrow scope that usually doesn't happen. Seed investors set a very wide scope and let's do this, let's do that, let's experiment. You'll run out of money very fast if you're just all over the place. So it needed both sides. It needed a little bit of anger. It needed all of that to get the company to the shape it had to be for the Series A. And once you got the Series A, we've never looked back. These guys have been almost militant in their ability to go neighborhood by neighborhood, build a supply chain, work backwards, give the farmers, the suppliers a great experience as a buyer. Today, Licious is the largest procurer of animal protein in India. This is a 7-year-old company. Meat is one of the oldest industries as a species. We've been eating meat for hundreds of thousands of years. It's Absolutely. The oldest industry, one of the oldest industries in the world. And in 7 years, these guys have become the largest procurer of animal protein in India. So at the first board meeting, we've closed the Series A. Our first submission to the board, and we're also board observers, is that, guys, everyone in the market, Swiggy, Zomato, all the food delivery guys, they're going wide, they're going to multiple cities, they're spreading their money too far. Let's be very clear, Bangalore is an $80 billion GDP city. It's going to $150 billion over the next 7 to 8 years. It actually became 180 billion. We were wrong. Bangalore grew faster than we thought. Let's just focus here. We can become the dominant brand in Bangalore. We don't need to go to so many cities. We don't need to spread ourselves too thin, right? And that was fairly anti-market advice. Everyone else is going wide. And these guys, I must say, everyone was nervous. Shouldn't we go wide? We won't get to Series B. What will investors say? They'll tell us we can only do it in one city, etc. We said, look, go deep and show better unit economics, and then go to the next city. It's a template you can repeat city after city, right? That's what's sensible for the business. Don't just do what's sensible for the next round, right? Because sometimes the market is wrong. Like we clearly already showed in the last round. That's how it takes time for the market to change their opinion with your data from reality. So I think that was also a good decision. They stayed in Bangalore. They got really deep. Today, they're a dominant brand in Bangalore. Even though there's competition, it's very hard to shake away that Licious retention and loyalty in Bangalore. And they've taken that template now to 15 cities. They've gotten profitable in the first 8. It's an extraordinary journey of a company taking a template and being almost, like I said, militant about not diluting their discipline on what it means to be successful in a city. And I think that's a proof point that they took for the next round. Now, Series B was the hardest round they had to raise. And I'll be very clear about this. The whole market had realized, the whole VC market had realized, there's something new happening here, right? There's something strange happening here. We were wrong about this D2C, full stack, supply chain, animal protein. We were wrong about all this. People are paying a premium to buy something they can buy in the neighborhood shop. Right? That's a very new experience back then. And D2C was a very new concept in India. Today we have D2C everywhere, from shampoo to shoes. Everything is D2C, new brand, startup, etc. Shark Tank, almost all of them are D2C brands. But back then, this was fairly an unusual story, right? So in Series B, every VC came to them saying, guys, something's changed, something's new, let's talk. And these guys were finally feeling like the divas of the ball because now everyone's shoveling attention on you. But what is actually happening is everyone is taking their business model. Everyone is thinking about, okay, it worked. Let's start the next company. Let's start another new compete, right? So I think the first time they realized, okay, it's actually not great to expose everything and be fully transparent and so on. We have to be a little bit more disciplined about how we take investor conversations, how we make sure that we don't give away too much data. And I think a lot of the things that happened in Series B, I think were not great. If I were the founders, I would be upset. They are upset. They were taken to IC, and then some LP member who was vegetarian said, I veto anything in animal protein. Those VCs should have known better that one of their investors will tell them, don't do this industry. It's unusual to waste so much time, take it to an IC, and then say no for that reason, right? That my investor said, no, I can't invest in you. And these are big VC firms. So I think a lot of things that they went through that experience gave them eyes wide open, a full exposure to all the things that can go wrong, even when VCs want to give you attention, right? And by the way, I'm part of the VC industry. So for me to say that a lot of things went wrong here and shouldn't have happened that way is, I think, a realization for a lot of founders that they have gone through as they've built their companies. So I think those are very valuable lessons, and valuable lessons for us also. We finally realized that what they will tell us and what they will do with the company is also very different, right? I think we have to get used to variance, like, it's a nice word to say, double speak, but variance in opinions and what we say. So we that thing that made the company stronger, I think that made the founders a little bit more alert and vigilant about what they had underneath their hands and therefore how valuable it could be. And since then, Series C, Series D, Series E, Series F, they've been very programmatic about why we're raising capital, who we're raising from. We are the market leader. We are the category creator. We will dictate the multiple on revenue that we want for our industry, right? They took full control of the process. They no longer allow the market to tell them you are worth 6x of revenue or you are worth 7x of revenue. They went to market and said, we are worth this X. You want the stock, you buy it. Otherwise, I have 3 other people who give me a term sheet. So that they turned the relationship, they turned the dynamic around, right? And for me, one of the most satisfying things for a company's stock that I own is the founders getting the confidence to dictate terms in the market, right? And of course, it peaked in 2021. They raised 3 rounds in 2021. I think they have one of the best cap tables in D2C in India now. It's a remarkable story. They're turning profitable very soon. They'll be planning for an IPO. They've already said it in the media. So a lot of good things about that company. And if they go IPO one day, assuming they do it successfully, I think it will be the newest type of business model to come into the index for a long time, right? And it will definitely turn a lot of eyes and be a fantastic story. And for us, we're still one of the largest shareholders. We're still on the board as observers. Of course, we hope we don't have to sell the stock during the IPO. Let's see. It depends on the timing. But an incredible journey. And I must say, full credit to them and a lot of very interesting learnings for us that we have since deployed and helped build many other successful companies.
Absolutely. And I think Pranav, the one thing that you said that I would like to focus on is that it is extremely important to achieve depth before you focus on breadth, right? You can go and start selling your product in say 100 different cities of India, right? But it won't work until and unless you actually figure out what it takes to win in a specific city. What is that template that you need to now follow in subsequent cities? And I think that advice that you gave to Licious, that was one of the game changers that actually helped them. And coming to the start of your answer, right, where you spoke about how Licious was initially struggling with fundraising, and I think the best companies are those which feel the most obvious when they're successful, right? As a consumer, Licious has solved trust for me. Licious has solved convenience for me, right? If I am say someone who is shifting from Delhi to Bangalore, or say from from X to Y city, I now know that there is one brand that I can trust and can easily consume their products, and that's something that's extremely difficult to solve. That Licious is just simply cracked. Let's dig deeper into what we've spoken about so far. So I'd love to learn about your personal philosophy. Okay, so I want to dig deeper and understand that what are some of the lessons that you've learned from your successes and failures as a venture capitalist?
Yeah, that's a question I think about every day, and I think it's important that like I said, when I started my career, working backwards, right? The first thing, the best advice I got when I was very young, one of my tuition teachers in Canada actually, was he insisted I tell him what I want to look like when I was 8, what I wanted to look like when I was 18. When I'm 18, what I want to look like when I was 28. And I've been doing that every year, right? Every year I paint a vision forward 10 years, forward 5 years. And if I'm not happy with where I am today, I am seeing my vision is changing, right? And I don't allow that to happen. So the discipline that comes from keeping yourself honest to what you committed to in the past, I think that is the most important anchoring you can have as a human being, right? And that is just that one piece of advice has made sure I am able to be quite honest about who I am. I am very honest about my motivations. When I am asked a question by a founder, look, will you screw me over one day? This clause is very difficult on SHA. I tell him, I can give him or her a very clear answer. I am not doing this to win an argument or to show I am smarter or to be better on something. By owning 10%, 15% of your company, and when I create wealth for my ownership, I create wealth for the remaining 85%, right? And I'm able to explain that venture is the only positive sum game that we're playing as an economy in India today, where my win is your win as a founder. The founder's win is the rest of the shareholders' win, right? And one day when as big a company as Licious or Swiggy or Zomato, all these guys who are going IPO are already gone, any founder will become 5%, 10%, he'll also become a shareholder, right? He's not going to have 50%, 60% like he used to when it was an early stage company. So what is good for the shareholder is good for everyone, right? Therefore, positive sum game. And you are able to go from your discipline, your motivations to this very brutal truth about what is a startup, right? In the end of it, as an economic engine. And you're able to link everyone back to who they are, why they're doing what they're doing, their motivation. So I think this loop, this trajectory, this ellipse of rotation between motivation to reality back to motivation. If you don't have clear motivations, you don't have discipline, you cannot do this. You cannot connect with another human being at this level. So I think that's a very important learning I've had. It has helped me become so much better as an investor. And I think more importantly, as a partner in the firm with 3 other partners, as a partner building my teams, a whole hierarchy of people who report into us, it makes us better human beings. I think that's one of the most important lessons. Second, I think this is learned along the way of being a VC. As an operator, I took a lot of responsibility onto myself, right? I'm the product manager. I will have to do this. The PRDs have to come out. The Scrum has to be on time. So we've screwed up on something. Some bugs have not come out on time. We take responsibility for a lot of the things that are happening, and they are your responsibility to deliver, right? Now, when you go from an operator to a VC, you don't have control over the things one company is doing day to day, right? I cannot step into Licious and tell them, you will now price it this way in Koramangala, you will now do this with some supplier in Hubli. If I start micromanaging, I will ruin that company, right? Because then my ego has somehow convinced me I am better in making decisions that these founders or their teams, all competent people, professionals, the best in their industry, somehow I am better than them, right? And I've seen so many companies ruined by investors thinking they can be operators, they can start micromanaging. So to know that I am playing a role, right? And the limitations of my role, the boundary conditions of my responsibilities, and most importantly, my ability to trust someone else and hold them accountable to an exchange that we've had as deliverables, right? And equally importantly, he'll put some things on me, help me raise the next round, help me plan this, help me find the multiple, help me find some debt. There are 20, 30 other things I can do that I am better at than he or she is, right? So to have this trust, to delegate, and then to set boundaries, I think is a journey every human being has to learn on his or her own. It cannot happen by advice. It cannot happen by some textbook. It cannot happen with a lecture on YouTube. And I think that's something that you have to go through, and it's become an investment I made every day in getting better at, and I'm still getting better at it every day. And finally, I think I'm looking inward at 314 itself. We started with 2 partners. Today we have 4. So as the team increases, as the partnership grows, as we get more and more leadership, maybe the team goes from 30 to 40, as the portfolio grows, as the AUM grows, we have to not forget what made us successful, right? And we should be very hyper vigilant in protecting the core DNA of 314 because it is truly built something unique in my point of view. But we also need enough paranoia to know that we could change in ways that becomes detrimental to who we are and makes us actually worse at what we're doing, right? So it's a weird balance between self-doubt and paranoia and confidence and assertion, right? And both, I can't verbalize. It's so difficult to know what is what and what is bad and what is good. And I think if you're not asking yourself questions every day, if you're not going through this interrogation of where am I, who am I on the right track, I don't think we'll ever strike that balance. And I think, therefore, the conclusion of that, the third point, is one day I will not be here. I cannot work the way I am working when I'm 28, 29, 30, now I'm 34. By the time I'm 40, I will have so many other obligations, personal and otherwise. And I know for sure I will not be able to work the same way 5 years from now, right? So a hyper self-awareness that just like a footballer, a professional cricketer, there is a prime, right? I have had to learn and realize this is a performance sport. Most VCs think it's a retirement employment. They do it towards the end of their operating careers when they're 55. If you look at the average age of Indian VC also, it's extraordinarily old. I think that's a big mistake. I think that explains why there's so many problems in this founder VC dynamic. If you look at VC as a performance sport, 30 to 45 is where everyone is doing their best work, right? And I know for a fact I will never get back time. And therefore, how I'm working now and how I'm pacing myself for my expected end to my career, I know exactly when it is. And therefore, what I will do every year and what I won't do and what I have to say no to and what I don't take on too much as overload, I think realization has made me also sharper in my discipline. That's just me. Now, 4 partners doing that, a firm of people doing that makes the entire firm that much healthier. And I think that is why a large part of what makes 314 special comes from the individual out, right? All of us going through that journey. So that's a quick summary of our lessons and some of the things we're doing every day to help us stay sharp.
Awesome. And I think the things that I absorb from this answer is that A, you're extremely cognizant of the human aspect of the power law, right? It's not just that you can invest in 100 companies and take a step back and just expect that okay, two companies will go. There are actual people, actual humans, actual teams, actual employees who are involved in all of this. So you work with them, ensure that they have the access to the right resources, access to the right support. And I think that's why you consider VC a performance driven sport as well, because you want to ensure that you are giving your 100% to these certain companies. And that is some, and it's not a retirement sport, right? You're just investing and taking a step back and be like, yeah, they'll be able to manage it themselves. So I think, yeah, that's incredible. But at the same time, also being mindful that you are not the operator yourself. At the end of the day, you are an observer, you're an investor, and you have to take that role and its responsibilities in the right direction. Pranav, I want to talk about the Indian bull case. Okay. So you're someone who has worked deeply with the startup ecosystem of India. Like you said, you've done almost 100 plus investments, right? So you know the space well, right? So from the minute you started working in the space, what are some changes that you've noticed over the years, and how do you see the Indian startup ecosystem evolving in the future?
Great question. Always one of my favorite topics to discuss. And I also learn something every time we discuss it with someone else. So really looking forward to that question. So here's a few things that we've seen change ourselves over the decade that we've been around tech plus plus. Now back, like I remember when I said back, looking back at India 2013, 2014, there was a sense of we're not meeting our potential, right? There was a shining India in the previous, when we were in school, shining India, something, whatever, in one of those campaigns. And the whole world had said, okay, India's come out of somewhere. They had seen China doing something similar. So the pattern back then was matching India to China, saying they'll both grow in these interesting ways. India's a democracy, China's not. They'll have their own part to success. India will have its own part to success. But honestly, we let ourselves down. We did not grow as fast as we could. And we had constant interruptions from policy, from different scandals. You remember all those things. I think bad management of the potential of the country, right? Now, a lot of the problems that were identified back then, if you do a retrospective, India has too many people, the birth rate is too high, the women are not as educated, the quality of the labor is not as skilled. A lot of those things have suddenly in 10 to 15 years have gone through fundamental changes, right? And today there are more women in education. In fact, the gross enrollment rate of women in college is higher than men now. So there are more women going to college than men at the same age. So many things have fundamentally changed since the problems were identified to today, right? Second, very importantly, there's a fundamental change of how government treats business, right? Back then, we had a license Raj until 1991, and I argue actually that went away, but the attitude in the bureaucracy has not gone away yet. They still look at industry with suspicion, right? And the license Raj is gone. Government still owns so many industries. Government is still a large part of an industry. Government is using taxpayer money to compete with industry. A lot of things that should not be happening in a market controlled environment, but we have it. That's fine. It's a pseudo stable state. India's reality is what it is for a very specific reason. So eyes wide open. What is India? What is India's fundamental driver of its economy? And the role demography is going to play, right? 20 years back were different to 20 years now. In the future, if you add all that up together, here is what we saw in 2015, 2016. Number one, we saw fundamentally there was a shift in the policy environment of India, and more responsibility was being placed on industry to help take the economy forward, to create jobs, to open up exports, to lead manufacturing, to indigenize certain industries like financial services, banking, so on and so forth. So we saw that now there's a focus on holding industry accountable for growth, for job creation, et cetera, right? So far, the burden was always in the government. They had assumed we will do it. We will create jobs. We will pay industry. We will do this. We will do that. So I think the burden has shifted, right? It's taken a decade for us to see the results. All right. So private companies are building ports. Private companies are importing oil. Private companies are building India's cars. It's no longer these government companies and so on. Private government is procuring private cars. That's a big shift that's happened. Now you see Toyotas and Marutis and so on in the government entourages. So you're seeing a fundamental shift of the responsibilities, government and industry, and the dynamic between them. That's very important. Third, both of us were in school around the same time, I'm assuming. I have seen a remarkable shift in the confidence of young people when I was in school and college compared to today, right? My own confidence in my country, of course, I always wanted to come back, so forget me for a moment. But if I generalize, the confidence of being Indian today, the confidence in the Indian passport, the confidence in the Indian engineer and the Indian doctor and the Indian lawyer, all of the skilled workforce, even the blue-collar workforce, there's a pride in being Indian suddenly. Okay. And that pride and the confidence that I will do it, I will earn, I will support my family, I will take a job, I will get a promotion, I will start a company, I will go on Shark Tank, which I still credit Shark Tank by changing the narrative about startups for mass media. I think that is a remarkable change in the demography, right? So 1.5 billion people not confident versus hundreds of millions of people getting more and more confidence every year. Suddenly the whole balance of the economy can change, right? And we keep talking about India as a consumer economy, consumption is driving the economic growth and so on. A confident consumer is so much more vital and economic engine compared to one that's not, right? I think that's you can't measure this, but there are surveys about, do you like your prime minister? Do you like your government? Will you stay? Will you leave? Etc. Etc. All the surveys are also showing you that there's a big shift happening slowly, but it's happening, right? And now pull all this together. What do we see as the investment case for India, right? Four convergences are happening in India. Four forces have come together to superimpose on each other that did not come together before. First, we finally have a consumer ecosystem. Say 200 million people in the top of the e-commerce generation. Let's put it that way. They will spend money on Flipkart, on Amazon, whatever. People say it's 100, people say it's 150. We look at the unique accounts that have been created, it's around 200 million. So 200 million people now have experienced digital consumption. And they are very clear now, they are willing to pay for products that come to them after they pay and then it comes, right? So that's a very different thing. You usually go to a shop, give me money, give me the thing. Like it's literally in two hands at once, it's parallel. But here you're paying and you're waiting for 3 days and hoping it comes, right? Now, 200 million people have had that experience. They're willing to trust digital product services. And we have companies like CheQ, FM, Licious, dozens of companies that are showing that people will pay premiums for things, for better experience, for better quality, that people thought India would not happen. CheQ FM is showing tens of millions of Indians will pay for something digital, purely digital, that they can get, that people thought were able to do piracy or YouTube for free or whatever. They're willing to pay for simple content in their language, high quality, without interruptions, without ads, right? People, and mass India, these are security guards, drivers, not Spotify generations like us. So dozens of companies, not just in our portfolio, across the ecosystem, have proven that now this consumer class it exists, it's large, and it's growing, right? And that's going to contribute 60% to the GDP of the country, and it's going to continue to grow at a pace that helps us grow at 6, 7, 8%, whatever targets we have for 5 trillion, 10 trillion, etc. Now, number two, the big force is the enterprise economy of India, right? And here we have three fundamental advantages that very few countries have. One, look at our IT industry. Today, the IT industry employs 5.5 million people, 55 lakh people in India. They have trained another 50 lakh who have gone abroad, who have gone to different industries. They've been around for 30 years now. So the alumni of the Indian IT industry is very large. It's the largest alumni of IT in the world. Even the US has not trained this many people in IT so far. So if you look at what that say 10 million people have done, they've all become middle class very fast. They've all started buying cars, ACs, expensive houses. They've gone abroad, they're emitting money, etc., etc. So their confidence in their own skill set and their ability to represent the country in different ways is quite interesting. And second, finally, the IT industry itself gets close to $160 billion of foreign currency coming into India every year as revenue. 90% of their revenue every year is coming from clients outside India. Only 10% of their business is in India, right? Today, India exports more software than Saudi Arabia exports oil. All of us have heard that. And that's a massive turn of balance in imports versus exports. It's a pure digital industry. It's pure people, knowledge base. It's the highest quality work you can give. And for us to have that advantage in India, I still think our government has not realized how important it is. Now, couple that with all the other things happening. The largest two-wheeler companies in the world are Indian, right? The largest banks in the world now, HDFC is going to be the 4th largest bank in the world. So now we're seeing financial services, auto, oil, food, cement, steel, etc. All of these industries are getting comfortable and confident of being the largest in the world. Right? And that's very important. I think Indian industry will create jobs that absorb the billions of people coming to the workforce and giving them the confidence to be confident consumers. So this is a very important loop that we have to close. Now, third, very interestingly, startups, right? We are building on the shoulders of giants. We are employing people who are trained by Infosys, trained by TCS, trained by Wipro. We are taking the generations of companies that have come before and building the Flipkarts and the Swiggy and Zomato and so on. Now, in where I am in the early stage, I am funding the best people from Swiggy, from Zomato, etc., from the previous generation of startup. So all of us are building on the shoulders of giants. And the time for a generation in IT, it used to be 10 years, right? For a migration, for an upgrade, whatever. Now the generations come down to 2 years. right? Every 2 years, you're seeing churn, you're seeing new companies, you're seeing disruption. And 2 years is where the US was maybe 10, 15 years back when I was on campus, right? The 2 year cycles, the 2 year disruption cycles. So we are now very close to what the US was a decade back. We are very close to where China was a decade back. So now we can see that the startup ecosystem is also iterating much faster, and they are creating value in ways we could not predict even 10 years back. 10 years back, if you told me by 2022 we'll have 100 unicorns, I would have said, I don't believe it. I mean, I hope so. I hope I have a bunch of them in my portfolio, but it's hard to believe. But fast forward to today, very few people believe that, right? In our firm, we had a few projections. We said 2025, it happened in 2022. So we were wrong, and we thought we were being adventurous and positive. So I think in a lot of ways, the startups have surprised all of us. Of course, there's been some governance unicorns without deserving to be there. Revenues have to grow, profitability, etc. All that's fine. I would take the result and then fix those things versus not having the result at all, if you ask me. So I think the confidence that's come, we're building on the shoulders of giants, the confidence in the startup ecosystem, the rate of innovation, the rate of the generation gap closing. I think all that's very good. And I want to see more of these companies going public because then the index changes, right? A very famous example I want to give is to now in India, you can order breakfast in a company that's gone public on their app. You can pay for that breakfast using another company's app that has gone public. And if you like the experience you've had on both these apps, you can go to a third app that is by a company that's also gone public and buy the stocks of the first two companies that are public. Fantastic, right? That is what that was the millennial experience in the US. You like Facebook, you like Snapchat, you like Tesla, you like Apple, you can buy the stocks on Robinhood, which is also now public.
Right.
So finally, we have that in India. And I think the startup ecosystem's impact on collapsing confidence, collapsing industry, collapsing experience, collapsing spending and investments, all onto one level. I think that's a phenomenal advantage that we can build upon quite exponentially. And finally, I think the most important thing for me, we can make wealth, we can create all these billionaires, we can do all these things, unicorns, etc. But we still have 200 to 300 million people who are still emerging from the very bottom of the pyramid, as it's called in India, right? They've been getting government jobs, they've been getting that Mahatma Gandhi Rural Employment Guarantee Scheme. Now their children have gone to school, their children are going to college, the first child in their family to go to college, getting their first job, on a manufacturing plant floor. Some of them are getting into IT because they're very smart. These people work so hard. The children are so intent on pulling their family up. But this is where my grandfather was in the 1940s, 1950s, right? Now I'm seeing the same experience happening to Indians live today, right? And the first children are coming up, first batch of children are getting educated. Now we cannot let them down, right?
Right.
And when we got independence, 1947, Nehru took prime ministership. The government controlled everything. They killed private enterprise, right? They took over airlines, they took over banks, they took over everything. And we had 40 years of growth at 3% a year, 3% GDP growth for a country of close to 700-800 million people. It killed the country. It killed the economy. It killed people's hopes, ambitions. I don't want to say too many negative things. I think we still have not introspected to understand how much damage those 40, 50 years caused to all of us as Indians. Today, we cannot have these kids for the first time coming out of college and school. We cannot give them the same experience. So we have to create more jobs. We have to invest in their skilling, right? The government is having so much investment in skilling, job creation, Atal tinkering labs, so on and so forth. Everyone is investing to make sure this generation does not have the same poor experience we had 2 generations back from where I come from. So it's very important for us that we also make, as startups, we make our services more affordable. We include them in the economy. We help them get their first jobs. The industry is doing more to train. A lot of that CSR support is finally going and being useful. So that part of the economy, what I call the inclusion part of the economy, that if we build it differently, then even their rate of change, their generation gap up to becoming middle class will take less time, hopefully, than the 2 generations before me took, right? And if we now see all these forces converging, 3 big takeaways. 1, finally going through IT and being called coolies and all the harassment that our IT companies went through 30 years, all that is finally worth it, right? The Indian passport is worth something. The whole world respects India. This is our moment to shine. We cannot look back. We should not let this economy down. That's number 1. Number 2, I think young people have more confidence. Young people have more agency. Startups are giving them a vehicle to create wealth in ways they could not even 30 years back. They cannot misuse that agency. They should not misuse that opportunity. We have to make sure we're responsible stewards, responsible capitalists. We do the right way, right? So governance, etc., all that we discussed. And third, finally, like I said, the new Indians, the new emerging pre-middle class, if we are able to help them get faster, then becoming the third largest economy quicker, it's inevitable. We're going to be 5 trillion in GDP. We will beat Germany and Japan. They are third and fourth. We will definitely become third. Now, the only question is how fast can we go there, right? And if we do that well, it's guaranteed for us. It's guaranteed that after 5, we will go to 10. We'll be the only country in the world that has a shot at becoming double-digit trillion in GDP. No other country in the world will get there before India, right? So only US and China will be ahead. That's a different war to win, right? I'm not even talking about that. Just number 3, being comfortable, confident in being large and being number 3. I think that's enough. That's the best aspiration I have for my lifetime, the next 20 years. That is what I'm hoping to achieve in a small way with the investments that we make.
Pranav, one thing that you said that actually resonated with me a lot is that when you're a kid, right, you're taught that the 101 of investing is that if you know a company, invest in that. So I think 10 years ago, that answer would have been the kinds of Tatas or, a Reliance or Tata or those those house of brands that everyone is aware of. But for the next generation, that'll actually be, say, a Swiggy, a Zomato, a Licious, or a Cuckoo FM, right? Those would be the kind of new age businesses that people would actually know of and then be like that, yeah, I want to buy a stock of that. And I think that's important. And definitely, Pranav, I completely resonate with you when the key word here is, like you said, confidence, right? Confidence in ourselves as a nation, confidence in our abilities as a nation, confidence in our growth as a nation, and not just at a national level, but I'd say a personal level as well, right? We as a country have together evolved, we as a country have together developed, we as a country are together upskilling ourselves, and we are actually, all of that is contributing towards our soft power as a nation, and that is actually helping us grow even further, that force multiplier essentially. And yeah, I think I think that's incredible. And definitely, yeah, that's the reason why I started this podcast, because that is what I want to highlight here at the Indianaut podcast. Yeah. So Pranav, let's switch gears now. First of all, congratulations on 314 Capital closing its 4th early stage fund with $200 million back in May 2023. That's incredible news, right? You have been really successful in raising funds in a challenging environment, right? Partially due to the relationships you've built with your LPs over these years, right? So can you share more about your approach to building and maintaining relationships with your limited partners?
Absolutely, and thank you. And it is a challenging environment, but a lot of the preparation you make, like you said, I think that lets you be consistent in spite of the whipsawing, like I said, over 10 years that we discussed before. So a few things at 314 that we're doing quite intentionally. One is, like I said, that 100 rupee example I gave you, right? The model and all of that. Now that's done quite well. I'm quite happy. There's a mathematical solidity to it. It's quite reliable. It also allows us to adapt to changes that we're seeing in reality. And so the model doesn't tell us, oh, reality is broken, our model is right. We are of the view that reality is what it is. That's where we have to make returns. Our model has to reflect reality. So I think that, therefore, the way we planned our cadence at 314 is we're mindful of 3 things. One, we're good at what we do, but what we do is the early stage, right? C to Series A, these many companies in the fund, this much of a check range and how much we can write, this much ownership that we take, therefore, and therefore these many companies that will create value, and this is what a fund can return over 10 years. So therefore, we're very clear, we're not middle stage, we're not late stage, we're not going to lead some Series Cs, we're not doing pre-IPO. We don't therefore have any dilution of our ambitions. We just want to be the best at what we do, right? And therefore, the discipline that comes from knowing that is all we do, right? And whatever we think of ourselves, like I said, we can go in very unique ways, but that is all we do. It gives you an immense discipline in, therefore, how large your fund can be, not should be, can be, to get the same results. And therefore, how often you will raise a new fund, right? So after all of our work, after obviously having showed that in practice for close to a decade, we are now at a point where we will have a 200 million fund for the early stage. We don't want to raise more. Every 3 to 3.5 years, not every 2 years, not every year, definitely not every 4 or 5 years. So we have a cadence and we have a size, right? And we established this cadence back in 2017. Fund 2 was 2017, Fund 3 was 2020. I still remember going live in July 2020, horrible time to raise. I must credit our LPs for having the confidence and trust in us to be able to be part of that first close. Terrible time to raise, even worse than 2022, I would argue. But we still got that Fund 3 launched in July 2020. And of course, Fund 4, exactly as planned, went live. We closed the entire fund's commitments by March. We went live in Jan, actually. So we just announced it in May. But we were able to start rebuilding our portfolio, a new fund in 2023 as well. So we've been 3 years, if you noticed. And Fund size, once we got to 200 million in 2020, Fund 3 was 200. Fund 4 has remained 200. That was very important, right? So in spite of Fund 3, 2023 being a bad year, we got close to 260 to 70 million of commits for Fund 4, the 2023 fund. But we had to tell our LPs we're not raising that much. We want to cut it back. We're only trying to go to 200. We have to say no to some new LPs, some new names. We could not take all the capital that was interested in investing with us. So I know it sounds unusual in a tough time like this. Why is a VC fund saying no to more money? But honestly, we're of the opinion that if we raise 250, say, first of all, what can we do with 250 that we can't do with 200? I don't know the answer to that, right? Secondly, now giving the kind of returns, the IRR that we've given so far on 250, yes, it's much harder than 200. That is true, right? And therefore, why do we want that extra burden? What are we going to do differently? Is a question we asked. We said we don't need it, right? We want it's a performance sport. We want to be the best performers in every fund that we launch in our vintage. 200 is the right size that allows us to express our model, but not take on the burden of too much capital compounding at the performance rate. So I think 200 has given us that balance. It is an unusual explanation, I must say. Most VCs don't have this explanation, but that is where we are, right? And I think that is hopefully going to serve us well in the future. Now, I'm very aware, and all of us, all 4 partners, it was a tough call to make to limit the fund size. I might regret this in 3 years. I might regret that it's a down year. We could have built more companies. We could have invested in more. We should have taken the more money. I am very aware we could have regretted this decision, but that's the right decision for us in our view. We won't regret it. We won't look back. We want the next fund to be in 2026. So the 3-year cadence continues. And I hope we have the right logic that continues going forward. That's a big explanation of how we've raised, what our cadence is, what the strategy is.
Not getting lost in the moment and taking on that capital, but staying true to your roots, staying true to your foundation, staying fixed with that anchor, right? That this is my approach, this is how much I want to raise at this moment, and this is what I want to do. I think that's incredible, and I think that's a strong will and determination that 314 as a fund is showcasing. So yeah, that's awesome. Let's flip it a little bit now, Pranav. So imagine that this episode right here is something that you would want potential portfolio companies to see. Okay. So from that aspect, okay, it is said that, selling your startup to someone or to investors is actually an art. Okay. So as an accomplished investor who has seen incredible startups pitching to them, right? What tips would you offer people for dealing with fundraising and the art of selling?
Great question. And a lot of the advice I was given on how to be a good fund manager and how to raise capital for myself, I think translates to anyone raising capital, whether it's a startup, whether it's a public market company, an investment banker, whatever, wherever you touch capital and you're raising it, right? So the first thing I was told, and I'm only giving advice that I have operationalized and I know to be true. The first thing I was told to do is be very impressive myself, right? So that means I have to work on myself. I have to have a clarity in my motivation, my health, my relationships, personal life. Do not raise capital and take on, fiduciary responsibilities if you are not prepared to execute on them, right? So for a lot of people, unfortunately, after reading the blogs and seeing the TV shows and so on, many people who start companies are starting companies to raise money, right? That is a very obvious motivation. It shows very clearly, right? And that would be the worst thing to do to yourself, your career, your reputation. So you have to be a very impressive human being that has worked on himself or herself and has, put your own motivations through the fire to be crystal clear why you're attempting to do what you're going to try to do, right? So when founders come to us, we're brute forcing, we're just punishing the motivation. Why are you doing what you're doing? Why do you want to solve that problem? What makes you the right people to solve that problem? Right? What have you seen that gives you some kind of insight or truth about that market that we don't know, or someone doesn't know, or some other founder cannot replicate, right? Where are the moats? How will you build this? How will you recruit people better than you, right? We ask tough questions, the people component. And the right answers come from strong people who have worked on themselves, built a core in here. And that core is very clear about what it means. The discipline is there to answer those questions and be impressive, right? So whether you're raising a seed round, whether you're going to an IPO, that is one consistent strength you can draw from as a human being. So that's very important. I have worked on it. You will work on it. Everyone's working on it. Do not be a founder if you don't have that clarified and worked out. Right? Some things will be incomplete, of course. Some things are a work in progress. That's fine. Be honest with yourself. But if you're honest with yourself, the self-dissection that you do in answering that question will tell you if you're ready to be a founder or not. Right? And that's really important. I think that's a very valuable skill. Second, now know your markets, right? As a founder today, so many of the obvious problems seem to be solved, right? When the Licious guys were pitching, now every VC was of the opinion that they pitched and said no, right? Every VC was of the opinion, will Indians care? Or I don't see any difficulty in buying meat, right? But dig into it. How many of them walk to that store and go stand in that line and the smell and the, it's really a terrible experience, right? Black packet, blood is falling out. Horrible, right? That what a founder is pitching to you is a solution to reality or not, right? So the same thing I would extend to the founders. Go through the pain of your market, live it, see it. Sometimes do an internship in some big company that's in the industry that you're trying to solve for, right? Live it before you are convinced that you want to solve the problems of that industry, right? So the best founders that we have backed have come from being turned crazy with the problem that they're trying to solve, right? And you'll heard many podcasts, many founders saying, I went through a problem and it convinced me to solve the problem. That's partly true, but also remember, not all the problems you face are venture outcome companies. Not all the problems you're trying to solve will be solved by raising venture capital. That's also true. So it's a superposition of truths. And if you have one clear lens on the right market, the right problem, you're the right team, you've thought about the right solution, you have the right business model, and venture capital is right for you, right? Then even you will know. It's an academic exercise that has a fairly straightforward outcome, right? So some companies, unfortunately for me as a VC, even though they're obvious businesses to build, it's not a VC fundable business, right? So at least in our point of view, and every VC has a different answer for what is VC fundable, what is not. That's where the founder's thesis and our thesis have to match, right? But the founder being very clear that this is a venture backable outcome. It's a big company, it's a big outcome. Technology has a role to play. There are moats, etc. That if they're clear to us on, and of course we have always done our work, we're also coming informed. When that matches, magic happens. Okay, I can tell you for sure as a founder, if you have it, you'll know it. And lastly, I think one of the more weirder things, right? Along the way, we realized a lot of people have sometimes a need to be solo founders, right? It is important for them to be alone in being the founder of that company. Now, VCs, if you read the blogs, if you read the tweets, VCs are not funding solo founders today. VCs are not funding. Now they want 3 founders. Sometimes they want 2 founders. It's all kind of weird heuristics, right? I don't understand. We don't have those kind of heuristics, honestly. Our opinion is very clear. Some founders have to be solo. Okay, there's no getting away with that. For example, whatever you say about Zomato, it is Deepinder's company. He is a founder. He's a CEO. He is the maniacal force behind what was such a large company, such a large outcome, right? Whereas if you look at some of the other companies that have 2 founders, both of them have a role to play, right? So I'll take Licious as an example. Vivek and Abhay, both of them needed to bring very different energies for Licious to be what it was. And it was a really scary problem to fix. So you need some variance in the founding team. So what we like founders telling us is why is a founding team the way it is? Okay, why both of you? Why only you? Why 3 of you? Right? Now, we don't have heuristics. We don't say come back with 2, come back with 3. We will ask you and we want to be convinced, right? And founders sometimes don't have the answer. Oh, we just went to school together. We thought we'll start a company together. That is the worst reason, right? So I think founders have to work on who is the team, who's the founding team, why are you guys here, why the 3 of you, why the 2 of you, and most importantly, what you will do differently that the other guy can't do. Okay, one of the best founding teams, one of the best pitches I remember. I can't give the name. But there were two guys. One of the guys told me, dude, I'm actually scared of this guy. Right. And I'm scared of how he works. I'm scared of I'm scared of him. Right. And I think the industry we're going after, I need a scary guy because I can't do that. I need a scary guy who can do it and get me results. And of course, he said, what I can do, the discipline I have, my temperament, my calmness, if he doesn't have it. And if he walks into the room to talk to people that he should not be talking to with that kind of energy, he will lose it. He will not be able to close. That's why he needs me, right? So that's you can't train this answer, right? It comes from people having really spent time and understood the dynamics. So I think those are kind of things that we read. We're always reading people, but founders having read it and telling us, it shows us a self-awareness that we can back. So some subtle things, look, everything else is a blog written, how to approach this VC, how to write a cold email. I'm not going to bore you with all that. I think all of those are now fairly tribal information out there already.
Right.
These are subtle things that I think founders may find useful.
Right, definitely. And I think just building on that answer you said about how founders working together and the founding team itself, I think if you are with people that you're not comfortable with, but but all of you are, together as a unit solely for driving that company towards success. I think that is what matters the most, right?
Absolutely.
This might be a person you're not best of friends with. This might be a person, you're not drinking buddy of. But at the end of the day, this is a person that motivates you and drives you to build this company as much as you do to him. And I think that's the key thing that you're looking for as a business, as
Absolutely.
an investable business. Awesome, awesome.
Absolutely.
So, building on the last two answers, I'd love to understand that, what are some of the sectors that you're bullish on? So, first of all, while I was researching into you, I read that you've mentioned that 314 will follow a sector agnostic theory, right? So, I'd love to understand what are some of your favorite sectors right now that you are looking at, and why are you bullish on them, and why?
Absolutely. So we're sector agnostic for a very simple reason. Most people look at sector agnostic and say, oh, these guys don't know what to invest in, right? We are sector agnostic because reality changes so fast. Markets are evolving so fast. I don't want to tell my investors I only do these three things. And then when the fourth thing becomes huge, I don't want to go back for permission to do something that is obvious I should be moving. That's my judgment, right? That's what I'm paid for. I want flexibility to be able to chase opportunity when I see it and when the market shifts, right? So very simple example of that. At 314, we studied digital health very closely when we launched. And we were very negative on digital health. We didn't do anything in pharmacy, delivery, in doctor software, in digital health, in dieting, and all these things. Like, there's a lot of companies tried, very few have succeeded, right? And a lot of problems with some of those GTMs and approaches and so on. So we said, look, it's not for us. We don't want to do that. There are other things we will do very well, and which has worked out for us. So we have excluded, we have what is called a negative thesis. We have a lot of negative theses. So we have positive thesis, we have negative thesis. And we have a negative thesis on digital health. Now, COVID came, it ruined so many theses for so many bases across the world. And if we didn't have our LPs trust in us that these guys have the flexibility to shift and they can change their minds when they see reality change, we change very quickly on digital health. Okay, suddenly there's like 4 or 5 things. UHID is coming. That's like a UPI moment for healthcare. A lot of things, top down, bottom up, a lot of things were changing. We had to change our thinking on digital health. We had to question ourselves, are we still relevant with our negative thesis in this market? And we went very, very positive. We've done 6 companies. They've all turned out to be great. Very excited about that growing for us going forward. So that's a great example of being sector agnostic is required to be able to meet reality and look at opportunity as market shift. So the 3 new things that we really like was for Fund 3, that shift has worked out. We have good companies now. Some of the newer things I'm very excited about. One, I think the policy environment has changed very rapidly for Indian manufacturing, right? So for us, we're looking at all of manufacturing and we're dissecting it in 3 buckets. One is there are manufacturing companies that are just great companies to invest in, but they will go public and it's a very linearly growing business. It needs working capital, capex, etc. The technology is not a moat. There is some IP, of course. They have IP in different ways, process IP and so on. But it's not a VC-backed outcome. It's not for us, at least, right? So we're staying away from a lot of that. So manufacturing for railways, manufacturing for this and that and so on. A lot of those things I would love to do because I can see you can make money doing it, but it's not for a VC like us in tech. That's one. So that's one bucket. Second thing are all the enablers of manufacturing, right? Where technology definitely can play a clear role, and we're very positive about enabling Indian manufacturing. So there's already a lot of success and many unicorns in these B2B marketplaces, right? That was a big trend from 2018 to 2022. Now, unfortunately, those thin margins have, a lot of those companies realize those thin margins are actually a problem. It's difficult to turn profitable. And the moats after a while are in pricing and relationships, which can be displaced by better pricing, right? So a lot of those companies are doing 2 things. They're going full stack. They're acquiring manufacturing units to improve margins. You're seeing that in the news, which is fine. They've got into scale where they have enough capital to buy in. Many of them are turned profitable already and fantastic. And I hope they go IPO and they will change the index. I'm rooting for them. But a lot of them could not stay pure tech forever, right? That's clear from the first batch of successful companies. So we look at technology in that enablement bucket now. And we're looking at cross-border. We're looking at export linkage. We're looking at cross-border finance. We're looking at cross-border logistics. And we're seeing a lot of opportunity there where you can stay tech. You don't have to own planes and you don't have to become FedEx and you don't have to own warehouses and so on. And you don't have to buy freight ships and everything else. You can build software layers connecting all of this and you can make great margins by tying up with exporters, importers, both ways. So that's a big area for us. So, I mean, there are 3 buckets here. I'll stop at this. That's one big cross-border and in specific manufacturing enablement is a big theme for us. Second, we're now finally seeing support for IP-led businesses in India, right? For the longest time since I've been an engineer, there's been a truism that's top down that's told to us as Indians. If you're a smart guy, if you want to build patents, India stuff, India patents take too long, India this, India that. Our universities are teaching universities and not research universities. There's this whole mythology force-fed on us that forces smart people to go to the US or wherever and file patents there, become PhDs there, do their IP work there. You look at Boston Dynamics, you look at OpenAI, so many Indians publishing papers in the best in the world, but they're doing it elsewhere, right? I think a lot has changed in the IP environment for India. Now our papers, our patents, everything has gotten easier. A lot more improvement, of course, needed, but we're definitely in the right direction. And now we are seeing that Indian companies that are Indian startups domiciled here that have IP, anything from digital health to semiconductor design to something in software, AI, whatever, you can file IP here and you can build product companies out of that IP and go global really fast. Right? We've had a bunch of successes in that already. We have drug discovery companies in our portfolio. We have medical devices companies in our portfolio. We're now seeing something in robotics and manufacturing enablement also, which is IP-led. And we're seeing that more and more of that can happen from India. And suddenly the cost arbitrage of IP, of development, the density of talent, and our ability to speak English and sell confidently globally now. Now, the whole world is willing to buy Indian software, Indian products, Indian manufacturing. So IP-led growth global, I think, is a big area that we're paying a lot of attention to. And you won't be surprised to see Indian space companies, Indian health companies, Indian semiconductor companies getting VC funding now. Sequoia has done one, Matrix will do one. So a lot of these things are going to happen. And I think we've been doing it from 2017. So I think now the market's caught up that this is definitely possible. We will be doing a lot more. And third, I think the most interesting thing for us is if you notice Licious, for example, it's a full stack, D2C, it's a D2C brand. Yes, it's a very powerful brand, but it's a full stack supply chain company.
Definitely.
Right? We think now, what is full stack? We think what is full stack? And we think how deep you go up and down. The vertical that we are interested in, that we studied, we can go deep in different ways, right? And full means different things in different flavors. So we're big believers in the agri full stack, for example, in horticulture. Their margins are large enough. The Indian soil and the Indian climate is productive enough. And the Indian farmers are much more sophisticated than the mainstream media thinks. These are not like those typical guys with a bull and a plow and a woman with a butu on top.
Of course.
That's not the Indian farmer. That was 30 years back. Indian farmer today is a massive producer, very greedy, which is good. He's ambitious, and he wants to export everything from capsicums to roses to coffee, tea, whatever, right? So there's a lot of interesting things happening in full stack application of software from the bottom up that we can replicate our lessons from Licious in other industries. We don't have to build brands anymore, right? We can do it B2B, but full stack. We can do it B2C, but full stack. And we're looking at everything from aero and drones to farming and horticulture. And we're seeing full stack companies being built in interesting ways. I still don't know a theme to label all of this, but we call it like full stack engineering at 314, and we're going quite interestingly deep in all of these interesting ways. So those are three big areas. I know they sound a little unusual to a typical founder, but what we're trying to do at 314 and what early stage VCs are supposed to do in theory is we're supposed to preempt the market, right? If everyone is starting just what is hot today, right? For example, cryptocurrency in 2021, we still don't understand why so many great founders were starting crypto companies in India. It was obvious it wouldn't work, right? I mean, you and I both know the RBI regulation, this, that. It was quite obvious to be very difficult. We have done 0 crypto companies. We felt like idiots in 2021, but we had to keep telling ourselves, look, how is it going to work? We still don't have an answer, right? So instead, what my advice to founders would be, this is the only advice I will give. Don't do what's hot today. If you want to build success, preempt the market. Think like religiously, fervently think, what is the future going to be? Work backwards. And you'll see opportunities to start today that are not mainstream, but will get mainstream quite quickly.
Absolutely. And I think on the second theme that you spoke about, right, which is linked to manufacturing, I think here another aspect that is actually a theme that has come up in our conversation a lot of times is also that when we see conducive government policies and when we see conducive government support and compliance support, right, that actually uplifts the sector much more. And we are seeing that in today's day and age as well, right? There are multiple production incentives that the government is launching and it's time to come up with to support various industries, be it semiconductor, be it EV, so on and so forth. So I think that makes the second bet that you talked about extremely lucrative because there is government support, and now VC businesses like VCs are also looking at this as VC investable businesses and not something that wherein once upon a time that this is a traditional business, this is not something a VC invests at. So I think the convergence of both of these factors will really boost this sector much more. I think this is another thing that's been there throughout our conversation, that depth is extremely critical. If you're able to achieve depth in whatever you're doing, you're a VC investable business. Right.
Almost always.
Almost always. Absolutely. Pranav, thank you so much for this conversation. This episode is honestly a plethora of nuggets and deep insights for aspiring entrepreneurs and aspiring Indianauts. And I absolutely loved this time with you. Right. Thank you so much for coming on the podcast and taking out the time.
Thank you, Gautam. First of all, very grateful for the invite. I love the fact that people like you are taking the time out to help spread insights from the market. I hope this was useful. I really hope all of us can work together to take the country where it should be, where it can be, where we know it is going. And I'm very excited about what's to come, for sure.
Absolutely. Thank you so much, everyone, for joining us for this episode. The Indianaut podcast is available on YouTube, Apple Music, Spotify, and Google Podcasts. Be sure to follow us on Instagram and Facebook to receive all updates on the upcoming episodes. We'll see you in the next one.